Good afternoon. It is August 19th, 2020. Robert Rayburn here from LifePro Asset Management. Hope that everyone's having a great August so far. We're just past that halfway point here of the last full month of summer. It's unbelievable that summer is almost at an end when we think about it. But certainly we've made a lot of progress here in the summer months. It's usually a period of time where markets tend to consolidate, are fairly quiet. But, thankfully for the client portfolios, we've been able to make some great progress in terms of growth. But the question always is, what's next? And that's what we're going to address today. We're going to talk about the election a little bit. And overall, what are the actual factors here that we think are going to move markets, and in particular, our client portfolios going forward? As usual, if anyone has any questions, please don't hesitate to call our offices at 888-543-3776. We're here to help. We're here to answer any concerns that anyone may have. But let's go ahead and get started. Recently I was listening to a radio show and I heard a phrase and I thought it was spot on. And that is that presidents don't make markets, markets make presidents. And for the last few months that we've really been insistent on delivering a message that the election is a known risk. We know it's there. It's very similar to, if someone's coming at you on the street and you see them coming, you have time to protect yourself. Versus the risks that we worry about are the ones that no one's talking about. And for any of those on the call today that have ever traveled to England or the United Kingdom, one of the things that you'll learn is that one of the leading causes of injury for Americans in the UK is that instead of looking to their right, they look to their left before they cross the street. And the problem with doing that, of course, is that traffic goes the opposite way there. And I thought it's a great analogy because a lot of the times the risks that we're all focused on are the risks that we can protect ourselves from because we see it coming. But it's usually those risks that can sideswipe us and come out of nowhere that really can leave some damage. And that's really where we focus our attention on. So in terms of the election, it's something we're obviously watching. We don't want to ignore it. But at the same time, we're going to stay focused on on those individual companies, what those fundamentals are, and whether or not any sort of asymmetric risk is going to present itself and impact the business models of those firms that we're invested in. But today we're going to go over the recovery. We're going to understand the sustainability of the recovery, where we are in terms of the recession, and whether or not the budding recovery is sustainable and what we see for the nature of that recovery going forward. Also, what does the end of a recession look like? We're going to go over a few charts that show historically what that looks like. And then lastly, we want to review investor sentiment. It's such a big factor in terms of what we do here at LifePro Asset Management because it really allows us to understand cash flows and where investor fund flows could go to next versus trying to chase, trying to be the last dollar in every various asset class. In terms of our returns, we talked a little bit last week. We had that pullback. One of the things we talked about is don't try to stick handle the week to week. Good companies are going to continue to rise to the surface. And lo and behold, we've come right back. Year to date, we're up 52.76% after fees versus the S&P 500, up around 4.92%. Going back to inception there, up 148.9% versus 51.4% for the S&P. So we've been able to deliver around 47.84% of outperformance this year and 97.5% of outperformance since the inception of our strategy in 2017. So we're happy with that. As we say every week, though, we want to make sure that new clients and existing clients have that same prospect for growth moving forward. That's how we grow our business. That's how we grow client accounts. And that's how we make your overall investment strategy sustainable, not just for the next 6 or 7 months, but for the next 3, 5, 7 years and beyond. Other thing this is a chart that we, excuse me, this is a chart that we showed last week. And then we actually sent out a separate email talking about it. But real quick here, don't get scared of the recovery. One of the big mistakes that we saw in 2009 was that people were so shell-shocked from the financial crisis that as soon as the market started to rebound in March, April, May, and June of 2009, they immediately sold and went to cash, or they stayed in cash, and they missed out on that 9-year bull market. That was the longest and strongest bull market in history. We do not want to make that mistake. So when we look at the way the market has behaved so far since the bottom in March, it's almost tick for tick exactly like it was in 2009. The only difference is the amount of cheap money in the system today, which is almost 4 or 5 times the amount that we saw back in 2009. So you can imagine the positive impact that will have on asset prices going forward. But certainly, this is probably one of the more important charts to pay attention to today. The other thing is just reminding advisors, reminding clients that stocks lead the economy. And it's so easy to get caught up in the economic data. It's so easy to get caught up in the media rhetoric, the election rhetoric, politics in general, that we need to remember that the stock market tends to do a very good job of seeing what things are going to look like 6 to 12 months from now. And historically speaking, stocks have bottomed 7 to 9 months ahead of the economy. So when we think of March and when stocks bottomed, we definitely are looking at this fall period here in Q3 as to, emerging signs that the economy is not only bottoming, but is beginning to recover and accelerate back into expansion. And as we invest, we're being accompanied by low interest rates, low inflation, and that rising supply of cheap money, which are allowing stocks to appropriately value themselves. The stock market is doing a fantastic job, as we'll see here in a bit, of separating the winners and the losers. And that's why stock selection is so important. And we'll go over that here in a bit. But I just think it's such a fantastic environment to reassert a long-term investment strategy. And we can see here the amount of liquidity. In that financial crisis, this was the blip up in terms of the overall supply of money in the system. Compare what happened in 2009, all the quantitative easing, record low interest rates, and then compare that to today. Let's remember that before COVID, the economy was in fantastic shape. So what we're essentially doing is we're seeing a bounce back in the economy today, and the only key difference here is the amount of money that's now in the system supporting the recovery. So we really do think that this is structurally, long-term, very, very positive for stocks. So sometimes the picture just says 1,000 words, but we just want people to see this chart and embrace it. In terms of investor sentiment, the amount of investor apathy in the system is structurally some of the highest levels we've ever seen. So we can see here, the market hit an intraday record high yesterday, and bearish sentiment is near its highs. Meanwhile, bullish sentiment has barely gotten off the mat. In other words, let's look at bullish sentiment back in March. This was in March. We're barely above March levels. So I think when you see the amount of cash on the sidelines, you see the amount of cheap money that's sloshing around in the system, you see the companies that we're investing in that have improving day-to-day fundamentals in their actual business models, the amount of cash flow they're generating is incredible. All of these factors combine to make us super excited about what we can do for client portfolios, not just what we have done, but what we can do if we take an appropriate investment strategy going forward here over the next 12, 24 months and beyond. And again, what are actual stocks telling us, right? So we always talk about how the stocks lead the economy. This is the transportation sector. So this includes rails, this includes autos, trucks. This is the transport. So in other words, sectors that are very economically sensitive. This is the transport stocks relative to utilities, which tend to be very recession-proof. We can see here it's broken a multi-year downtrend. In other words, these economically sensitive stocks are beginning to outperform the recession-proof stocks. Picture says 1,000 words, and this definitely says a picture that is endorsing this idea that the economy is coming back. Here on chart on the right, forgot to label this one, but doesn't this look like a really good chart? And what is it? It's copper, believe it or not. Dr. Copper. Copper does not go up ahead of recessions. Just something to remember there. Copper is spiking up to 52-week highs. The transports are breaking out relative to more recession-proof industries. This is a positive sign for the overall economy. In addition to that, though, the market's doing something that it's supposed to do, and that is discriminating between good companies and bad companies. What we did here is show a chart here on the left that shows the distribution of stocks within the S&P 500 that are down versus up. And what we can see here is, yes, the market is now up around 4.5% year to date, but look at the amount of stocks that are trading down year to date. In fact, over 100 stocks on the S&P 500 are down somewhere between 25 and 50%. Another 26 stocks on the S&P 500 are down 50% or more, and another 92 stocks are down an additional 10 to 25%. So what this tells us is that stock picking matters. If you bought an index product from Vanguard or from any other vendor, what you're doing is you're essentially buying stocks across all of these return distributions. What we've been able to do effectively this year, at least, is been able to say what are the companies that are well positioned, not just for a COVID environment, but in a reopening phase, and then focus on the best and brightest companies that are available, that are leading positive disruptive change with solid balance sheets, good health, and are generating good, sustainable, long-term free cash flows. And if you notice, our year-to-date returns are up around 52%. So this puts us in this top tier, and that's really what's happening here. In terms of the election, real quick, when we look at the volatility curve, this is what we're talking about. The market knows the election's there. So the amount of portfolio protection that is in demand right now is quite elevated just before the election and just after the election. But take a look what's happening with the volatility curve. It's quite elevated for months afterwards. So if the election turns out to be if the election turns out to be a little bit less than feared, in other words, it turns out to be okay, the gap between 22 and 30 here is the amount of risk on activity, in other words, cash that could be pouring into the market. So when we think of all that cash on the sidelines and everything else, it's a reflection of this fear that is based in Q3 and Q4 of this year. So this is further dry powder that can fuel stock prices higher in the future. So overall, the long-term recovery based on our homework, based on the data, is just getting started. The liquidity and fundamentals remain supportive for stocks, not just today, but over the next 12 to 24 months. And what we would definitely say is, listen, you can, a product like Vanguard does a great job getting investors acclimated to what it means to invest in the stock market, getting them used to the ups and downs, but overall the long-term upward direction. But once you're used to it, it's important to introduce a more sophisticated level of investing to your portfolio, a more active investment sleeve. And that's where stock picking definitely remains a critical component to investment success. We would not voluntarily invest in bad companies on a one-on-one basis. So let's not do that in our investment portfolios. We're here to help. That's what we're trying to do on a daily basis. So far, so good, but every day is a new day. And moving forward, obviously, investor sentiment continues to be a huge asset for stock prices going forward. Thank you again for your business. Thank you so much for your mentorship in terms of all of our clients and advisors that call us and have those conversations with us. We learn so much from you, and we could not be more excited about the future. Thanks again. Have a fantastic week. Enjoy the rest of the summer here. I know it's hot out there, so definitely go out, enjoy the weather, and we look forward to speaking again next week. Have a great day. Talk to you soon.